morning to everyone. I welcome you all to this live interactive session or a visionary session on advanced capital budgeting. It is one of the prominent and important topics when it comes to CA final paper 2 financial management. I'm sure we have revised uh, quite a few topics this subject till now. We have definitely seen all the important topics like the portfolio management, mutual fund, security valuation, right? Business valuations. Most of the topics which are quite relevant and quite interesting enough that has been already covered. We are now going for the next important topic, which is advanced capital budgeting. Now, we all are very much aware about the capital budgeting techniques, which you might have already learned in your CA inter level. At CA inter level, you have already uh, discussed the techniques of capital budgeting, which includes like calculation of NPV, calculation of IRR. So of course, all of that is already covered. What we have in final level is one step ahead of. So you're just not looking at to calculate um, NPV or IRR. Rather, we are one step ahead in sense that we are looking at some practical possibilities that we may face when we are designing the capital projects. Okay. So with that point of view, we'll be revising this topic today with three numericals. But before that, we will just quickly recap the concepts that we have. Okay. So we'll recap the broad concepts that we are supposed to be discussing in this. And then we'll obviously take up three of them numericals. Okay, so the three broad areas in which we are going to discuss the capital budgeting topic today is going to be one is regarding the impact of inflation. The first part is the impact of inflation. Yeah. So the three broad areas that we cover in advanced capital budgeting, it includes first and foremost the impact of inflation. Second is the risk measurement and risk management in the capital budgeting projects. So that essentially includes the risk management tools like your calculation of probability, variance, standard deviation, coefficient of variance. Some of the conventional techniques that we used include sensitivity analysis and risk-adjusted discount rate, obviously account for the levels of risk which the entity is undertaking, and based on that, just the rate of discounting. Because the rule is simple: if your rate of uh, if the risk in your project is higher, the risk in the project is higher, definitely you need to have a higher rate for discounting it. Then we also have certainty equivalent. Right? Other techniques include your sensitivity analysis, scenario, decision tree simulation analysis, and obviously last but not the least, which is calculation of adjusted present value. Okay. So one very important aspect of our discussion when it comes to inflation, we need to remember that inflation is going to be considered when in the capital budgeting decisions by simply looking at what's the rate of discounting and also the cash flows. So the rule was pretty simple, which we have already set, that the real cash flows and nominal cash flows are going to be two different numbers. Okay, so real cash flows are the ones where you haven't considered the impact of inflation, and nominal cash flows are the ones where you have definitely considered the impact of inflation, right? And obviously the real nominal cash flows are going to be higher because of inflation imbibed into that, and real cash flows are going to be smaller. Now, obviously, since the real cash flows are without any inflation impact, the real rate of return is going to be lower than the nominal rate of return. Okay? And we have also seen that the simple relation between real rate and inflation rate, that's like 1 plus real rate into 1 plus inflation rate is supposed to be 1 plus nominal rate. So if we have a real cash flows, we are going to discount using the real rate. If we have the nominal cash flows, we are going to discount it by using the nominal rate. Okay? So if the cash flows are nominal and we have the real rate of return given to us, we can definitely compute the nominal rate and then discount it. Or else, if the cash flows are nominal, we can just make them pre-adjusted with the dividend, pre-adjusted with the inflation, and then discount using the real rate of return. So the rule has to be clear. Real cash flows should be discounted using real rate of return, and nominal cash flows should be discounted using nominal rate of return. One peculiar problem that we face when we are looking for inflation impact is impact of inflation on the CFAT calculation or cash flow after tax calculation. So we have already seen that cash flow after tax is what? Revenue. That's simply revenue minus cost minus depreciation. Right? So this is your profit after depreciation. So you just make it as an after tax figure by multiplying by 1 minus t. And we know we add back the depreciation. So when we just solve it, we find that the CFAT number gets distributed into two parts. One is revenue minus cost into 1 minus t. This is something which is impacted by inflation because the revenue and cost numbers are going to get affected by inflation, whereas the tax savings due to depreciation is not going to have any impact of inflation because depreciation is a fixed number. The amount of depreciation doesn't increase with an increase in the, the amount of depreciation doesn't increase with an increase in the inflation because depreciation is a constant number, right? It's just a book entry. It's a constant number. So that portion is not going to be impacted by any sort of inflation. Then going for the calculation of expected value and variance. So we know expected value of x is simply summation of probability into x. And then you have variance of x as what? Summation of probability into x minus x bar square. Standard deviation of x is going to be calculated as a square root of the variance. Okay, so that's pretty simple. Coefficient of variation is going to be calculated as standard deviation upon expected value. Okay. I'm just revising the concepts quickly so that later on we have having good amount of time for solving the practical problems. One important aspect that we have seen in this Hiller's model is what we call as when I want to calculate variance of NPV of the project, and we have cash flows of the project, right? We have cash flows of the project which are also different as per multiple scenarios. Okay. So if you have calculated, let's say, variance of cash flow for the first year, variance of cash flow for the second year. So every year you have a different set of cash flows. So every year there are possibilities of cash flows, most likely, least likely, and such aspects. So variance of cash flow in year 1 plus variance of cash flow in year 2 plus variance of cash flow in year 3, right? So these three, suppose if you have 3 years of the capital budget and each year there is a variance in the cash flow, then how do I get the variance of the NPV? Pretty simple. You just need to divide variance of cash flow of 1 year divided by 1 plus risk-free rate or 1 plus the rate of discounting square it because you have the variance, right? So variance needs to be divided by the square of the discounting term. Over here again, it's going to be divided by 1 plus r square, again the whole square. Variance of cash flow 3 divided by 1 plus r cube, the whole square. Right? So it's going to be like raised to 2, raised to 4, raised to 6, raised to 8, it goes on. Then you get the variance of the project. And of course, the standard deviation of the project can be simply taken it as a square root of the variance. Just take a note of this, one different thing. Then another aspect of risk-adjusted discount rate, that's pretty simple, risk-free rate plus the risk premium, right? So risk-adjusted discount rate is going to be calculated as risk-free rate plus the risk premium. So risk premium actually depends on the value of the risk that the project is having. So if the project is having a higher degree of risk, of course, the risk premium is going to be quite high. Another method of measuring or of inculcating risk into the capital budgets is to calculate something called a certainty equivalent. So certainty equivalent are essentially the proportion of the cash certainly received. Certainly equivalent is representing the proportion of cash flow which is certain to be received. And if the cash flows are certain, of course, we are going to discount it using risk-free rate of return. We're going to discount it using risk-free rate of return. Okay. Then there's another method of risk analysis which is called as a sensitivity analysis. Now, sensitivity analysis is simply trying to measure how sensitive the value of NPV of our project is if we look into the adverse impact on any of the inputs. Because in capital budget, there's always a set of input and there's always a set of output, right? So input is going to be your initial cost, units that you are selling, selling price, variable cost, fixed cost, discount rate. So if we are just looking at if there is some percentage adverse change in the inputs, what will be the change in the output? If there are certain percentage adverse change in the input, what will be the change in the output, that is, with the change in the output? Of course, we calculate the percentage changes and we just identify those variables which are having the greatest degree of change. Any input variable which is having a higher sensitivity needs to be controlled in a more effective manner, because any small change in that variable will lead to a large change in our NPV. Then we had also scenario analysis, wherein we look at the multiple scenarios, right? What is the likely outcome of the project under different scenarios? And of course, in pen paper mode, we just take it as 3 or 4 scenarios. But when it comes to practical implementation, we do have softwares wherein you can have these scenarios, maybe running into thousands, right? Which gives you a fair idea about what's the possible outcome of the project. Okay, then we have decision tree analysis. So in decision tree analysis, we simply try to test whether we should be carrying out the project at a particular node. So at a particular node, we are deciding whether we have to go ahead to the next step or not. And if we test that by the possibility that if we just go ahead and get some return, is that get some cash flow, is that cash flow sufficient to cover our initial investment and the cost we have inside, right? Another method, or one of the other advanced capital budgeting thing, was regarding the replacement decision. Replacement decision is deciding whether to replace an old equipment with a new one, and also it also involves the question when to replace the old equipment. So the first thing that we do when we want to calculate the replacement decision, whether to replace an old equipment with a new one, we simply look at what's the incremental cash flow from the new system. So of course, from the new system, what are the cash flow that we're going to get? We're going to get the incremental sales, any savings that we have, any incremental expenses, plus tax savings on any incremental depreciation. So any sort of incremental sales, savings from any incremental things or incremental expenses and tax savings, that needs to be accounted, and you compute the every year cash flow after tax, or it is basically incremental cash flow after tax. And then you simply take what will be the cash outflow towards acquiring new machine. Of course, when you are going to acquire the new machine, you need to look at what will be the cost of new machine, any sale value that they will get from the old machine, and also whether there is any tax saving from the loss on sale of old machine. Because when you are selling old machine, most likely you are going to sell it for a loss. And if in case you are selling it for a gain, you need to also account the tax that you need to pay for it. Okay. Then all those cash flows are simply taken as a NPV calculation. And if the NPV is positive, you go ahead with the replacement. If it's negative, you decline it. There's another aspect to it, whether deciding what should be the replacement tenure of an equipment. Like, whether should I replace it after 3 years, whether should I replace it after 2 years. So deciding that was pretty simple. So you are just going to calculate NPV for each of the possible scenarios. So if you want to replace it every year, you need to chart out what are the cash flows that we have and just calculate the NPV. And second case, if you want to calculate, want to check for after 2 years the NPV, then you check for if you have to replace it by 3 years, what will be the NPV? If you want to replace it by 4 years, what's the NPV? Remember, you can't compare the NPVs of 1 year, 2 year, and 3 year. What we need to do is simply divide this NPV by present value annuity factor. We are going to divide the NPV by the present value annuity factor. So that we get equivalent annual cost. And of course, the year of replacement in which equivalent annual cost is the lowest, that will be selected as the replacement tenure. Then the next important part for advanced capital budgeting is calculation of adjusted PV, which is obviously connected with your Monty-Granny Miller model, model, where we have already seen that value of the levered firm is supposed to be value of unlevered plus the amount of debt into tax rate. So we know that this debt into tax rate comes as present value of all the future tax savings that we are going to get. It's obviously going to be present value of all the future tax savings due to interest payments. So those additional benefits that a levered entity is getting, that adds up to its value. So same way, adjusted present value will be a base case present value plus the present value of tax savings on interest. The adjusted present value will be simply base case present value plus the present value of tax savings on interest. Okay. So base case present value is what? When you are calculating the present value, assuming that the project is funded by equity. So first you assume that, let's say the project is funded by equity. Okay. Let's say the project is funded by equity. Then in that situation, if the project is funded by equity, guys, then what's going to be the base case situation? So base case is essentially the PV calculated. When you are saying that there is no debt involved in it. And then you say, suppose if I take debt, what will be the new present value? So for that, we just take the base case present value. On that, we add the present value of tax savings on interest. We just add back the present value of tax savings on the interest. Okay, fine. Just we need to remember these aspects, right? And I think we are now going to start with the practical problems. Let me just start with the practical. Okay, so here we go. So we have three numerical questions to solve. Okay. And these are definitely going to be quite interesting ones. Okay. Let's start with the first one. Swift Express is one of the India's leading courier companies. The company operates a fleet. It's operating a uh, fleet of course, delivery vans. Each van is traveling approximately 45,000 kilometers per year. The company currently um, replaces its van every 4 years. However, the management is reviewing whether replacing them after 2 years or 3 years is going to reduce our overall costs. The cost of new van is given to us. Okay. So cost of new van is provided to be 8 lakh. The expected resale values are given. If you are going to replace it in 1 year, you are definitely going to get uh, value as 5,80,000. Okay. So the replacement value that you have for this situation is 5,80,000 in the first year. And if you're replacing it in the second year, okay, if you're replacing it in the second year, then you are having the value as 4,20,000. Okay. So then similarly, we have like uh, in 3 years, it is 2,80,000. In 4 years, it is 1 lakh. Uh, in 4 years, it's 1,60,000. And then during these 4 years, right? So during these 4 years, if you're keeping the machine with you, keeping the van with you, then what we see is that there is an insurance and tax. There's a fuel maintenance cost incurred for each of these years. Right? So in 4 years, it's going to be like insurance and tax is given, fuel and maintenance costs are given. Then we need to look at what is the company's opportunities cost of capital is 12%. We have to determine the optimal replacement period using equivalent annual cost method. Okay. So we have to look at what is the optimal replacement period using the equivalent annual cost or EAC method. Okay. So, of course, the goal is going to be pretty simple. I need to compute equivalent annual cost for each of the time period. So, let's just try to solve it. Well, I'll solve it in Excel itself. There's not much into write in this. So let me just solve it. So see, the purchase cost is the new machine cost is what? 8 lakh, right? And the resale values are given. Right? And of course, the annual operating cost is also given, right? So we do have the discount rate, which is 12%. We can definitely get the PV factors based on that. So first thing is, let us say you're going to replace after 2 years, right? Or after 3 years. So let us check if replacing after 2 years is going to be any benefit for us. So first option that we are testing is replacement of van in every 2 years. Okay, so first thing that we're looking at is what would happen if we are thinking of replacing it every 2 years. So if we're replacing it every 2 years, first we need to look at what will be the costs that I'll be incurring, right? So first thing is to calculate the present value of the costs. Here, particulars, cash flows, and present value. Okay. So of course, since you're going to replace it every 2 years, the cost is going to be incurred for 2 years, right? And of course, in the second year, also we are going to resell it. We're going to sell it, right? So first particular is operating cost. So operating cost for the first year is going to be total of insurance and fuel and maintenance. So fuel and maintenance is 280. Insurance and tax is what? 40,000. So that's going to be 280,000 plus 40,000. That's cash flow. And remember, these are all cash outflows, guys. So operating cost for first year is 320. And since we're thinking of replacing it every 2 years, I need to incur the operating cost for the second year also. So for the second year, the operating cost is 320 fuel and maintenance plus 40,000 of insurance. So that's going to be 320,000 plus 40,000 of insurance, 360,000. And of course, in the last year, we are going to resale value. We're going to take the resale value of the van. So resale value of the van is going to be 4,20,000 resale value, right? So that's a 4,20,000 inflow for us. Let's take the present value by first calculating the present value factor at the rate of, so we are going to discount this by taking 12% as a rate. So just take the 12% as the discount factor, PV factor, and then calculate the NPV in this case. Yeah, guys, calculate the NPV. Get the NPV, guys. Take the PV factor at 12% and get the net present value. Yeah, guys. So PV factors, so 1 divided by 1.12 raised to the number of years. So we have the PV factors available with us. We get the PV as cash flow multiplied by PV factor. Take a sum of all these PVs and we get the present value as 2,37,883. Okay, so that's 2,37,883. Okay, so 2,37,883. That's the replacement of VAT. That's the NPV that we have in case the replacement is done every 2 years. Of course, this is not something, which is final because, of course, I need to also calculate, need to also look at the purchase of the van. So we're just going to insert one more, is year 0, where we have purchase of van. So purchase of van is going to be costing us 8 lakh. PV factor of 1 and the PV is just going to be 8 lakh. Then we just take the sum of all the cash flows. So if you're thinking of replacing the van in 2 years, today we need to pay 8 lakh for the van. Operate it for 2 years. Of course, we are going to pay the operating cost for that. And then we are going to sell it off. So when we are selling it off, we are going to have a resale value of 3,34,740. 3,34,821. So that gives us a NPV as 10,37,883. And then we are not going to compare this number. What we are going to calculate is equivalent annual cost. The equivalent annual cost will be this particular number, which is 1,37,883. And we divide it by present value annuity factor. Divided by present value annuity factor at 12% for 2 years. Okay. So 10,37,883. And you divide it by present value annuity factor, which is of course the first year PV factor and second year PV factor. That needs to be divided by 1.690. We get the equivalent annual cost as 6,14,113. 6,14,113. That's the equivalent annual cost. That's the case if you are replacing it every 2 years. I need to check further what will be the equivalent annual cost for every 3 years and for also every 4 years. There, I need to compute this equivalent annual cost. So let us try to calculate that on the similar lines. So second option that the company is having is replacement of van in every 3 years. Replacement of van in every 3 years. Okay. So if replacement is done every 3 years, we're going to have cash flow in year 0, year 1, and also in year 3. So first we are going to have like purchase of van. Purchase of van. Cash flow is going to be 8 lakh. Okay. Then first year, second year, and third year, we have the operating expenses. So in the first year, we know it is 2,80,000 plus 40,000 is 3,20,000. Then you have 3,20,000 plus 40,000, 3,60,000. Then we have 3,90,000 plus 40,000, 3,90,000 plus 30,000, which is 4,30,000. So these are the cash flows that we have on the van in 3 years. And also in the third year, we're going to have sale value of van. And we know that if we're going to sell the van in the third year, we're going to get 2,80,000. That's 2,80,000. And then we are going to get the present value factor at 12%. We take the PV of it, right? Add them together and then we get the equivalent annual cost. So now I have provided you with these numbers. I want you to quickly calculate, just give you a couple of minutes. Calculate the present value. So just try to calculate the present value and the equivalent annual cost. Calculate the present value and also the equivalent annual cost. Yeah, just calculate the present value factors, present value, and then get the equivalent annual cost base. Okay, so we have the present value factors, simply 1 divided by 1.2 raised to the number of years. Okay, these are the present value factors that we have. Just need to multiply the cash flows with present value factors. Then we take the sum of it. Okay, so here we have this NPV. This because I need to take a negative number for the sale value of the van. So the NPV is what? 14 lakh 79,471. That's the NPV. Net present value is 14 lakh 79,471. So we have the equivalent annual cost. Equivalent annual cost are 14 lakh 79,471 divided by present value annuity factor at 12% for 3 years. So 14 lakh 79,471 divided by present value annuity factor will be, of course, addition of PV factors of year 1, 2, and 3. We have the equivalent annual cost as 6,15,976. Look at over here, replacing it every 2 years is slightly better, right? It is slightly better as compared to replacing it every 3 years. Okay, so replacing it every at every 2 years is slightly better, 6 lakh 40. Of course, we need to check for the 4-year category also. So let's check for the third option, which we are, doing as a company currently. Option 3 is replacement of van every 4 years. So replacement of van every 4 years. We have year 1, 2, 3, 4. Let me start with 0. 0, 1, 2, 4. And also 4th year sale value. So in 0th year, we have the purchase of van. And then we have the operating expenses. And then in the 4th year, we have the sale value of the van. So purchase of van is going to cost 8 lakh. Operating expenses are going to be 3 lakh 20,000 in first year. In fact, second year and third year, the operating expenses are going to be same. Fourth year, we are going to have a different operating expense now because that's the additional year. So 4 lakh 80 plus 40 is 5 lakh 20,000 is the operating expense. We have the present value factor at 12%. And before that, the sale value of van is 1 lakh 60. One lakh 60,000. So we take the present value factors and then take the PV. Calculate the equivalent annual cost base. Just give you a couple of minutes to calculate the equivalent annual cost. We calculate the equivalent annual cost, then we will be comparing all the three options, replacing it every 2 years, 3 years, and 4 years, and then we'll be obviously suggesting which of these three options is the best one. Okay, so present value factors, I'm pretty sure might have calculated the NPV. I'm just putting up the numbers for verification. So we get the NPV of the replacement cycle of 4 years as 19,07,556, and then we look for the equivalent annual cost. So the equivalent annual cost is this NPV divided by present value annuity factor at 12% for 4 years. So this is going to be addition of PV factors for year 1, 2, 3, and 4. 3.037. So that's 6,28,033. If we are replacing it every 2 years, that comes to be roughly around 6,28,000. So of course, now looking at all the three options, option 1, replacing it every 2 years, had an equivalent annual cost of 6,14,000. Option 2 had an equivalent annual cost of 6,15,000. And option 3 is having an equivalent annual cost of 6,28,000. So what suggestion can we really give? We can definitely say that replacement should be done in every 2 years. Replacement should be done in every 2 years so that the equivalent annual cost is staying to the limited or should it is staying at the minimal level. Is 6,14,000 and 113, right? That's the uh, solution to the first question that we were discussing, which is about the replacement thing. Okay, now let's go for the second question. Just read this second question, guys. Read the second question, question number 2. So we have XYZ Manufacturing Limited plans to invest 20 lakh in a new automated production line. The project is having an expected useful life of 5 years and there is no salvage value at the end of its life. Okay, so project is having an expected useful life of 5 years and there's no salvage value at the end of its life. Annual depreciation in the straight line method is 4 lakh. Projected revenues and operating costs before considering inflation are as follows. So these revenue and cost are the real cash flows where there is no adjustment for inflation. Okay, so XYZ Limited is subject to a corporate tax rate of 30%. Cost of capital, including inflation, is 12%. So this 12%, guys, it is the nominal rate. This is your nominal rate. Okay, the expected annual inflation rates are given for revenue and cost. There are two separate numbers. So assume inflation is cumulative from the base year. So it keeps on accumulating. So we have to calculate certain items like your annual depreciation, tax shield, adjusted, inflation adjusted revenue in year 2, inflation adjusted operating cost in year 3, total after tax cash inflow in year 1, and finally, using a discount rate of 12%, we have to get the present value of year 4 cash inflow. Okay, so let's solve it, as a full-fledged question itself, because we'll be definitely able to identify what all things do we have over here. Okay. So let's try to solve it. So first up, since our discount rate is nominal rate, we need to calculate the nominal cash flows. Okay. So first we need to calculate the nominal cash flows, and then we are going to definitely uh, discount it. Okay. So first up, calculation of nominal cash flows. Inflation needs to be adjusted for each of these numbers. Okay. We have the revenue, we have the cost. So writing it like this. Year, the life of the project, 5 years, right? So if we have year 1, 2, 3, 4, 5. Okay. So in each of these years, we're first going to take down that these before considering inflation. Remember, these are like before considering inflation. So we need to check for real revenue. Then we need to look for the inflation, and then we will calculate the nominal revenue. Okay. We have the real revenue numbers as 15 lakh, 17 lakh. 15 lakh, 17 lakh, then 19, 20, 20. 19 lakh, 20 lakhs, and fifth year it is 20 lakhs. Okay. So inflation uh, uh, numbers are 8%, 7%, 87654, 8%, 7%, 6%, 5%, 4%. So nominal revenue in year one, it will be 15 lakh into 1.08. Okay. 15 lakh into 1.08. That gives us 15 into 08 is 16 lakh 20,000. Then second year it is what? 17 lakh into, remember it's level 1.07 for the second year inflation. So I need to get 17 lakh into 1.08 into 1.07. 19 lakh. This is going to be 19 lakh multiplied by 1.08 multiplied by 1.07 multiplied by 1.06. That's 19 lakhs into 1.08 into 1.07 into 1.06. This is 23 lakh 27,378. That's year 3 nominal revenue. Same way, year 4 nominal revenue will be 20 lakhs into 1.08 into 1.07 into 1.06 into 1.09, right? That gives us what? 20 lakhs into 1.08, 1.07 into 1.06 into 1.05. That is 25 lakh 72,366. Fifth year it is going to be 5 lakh 72,366 into 1.04. This 26 lakh 75,261. These are the nominal revenue. Once we have the nominal revenue numbers, then same way we look at the real values of the costs, real cost. You apply the inflation to it and then get the nominal cost values. Guys. Real cost, inflation, and then get the nominal cost. Yeah, get this number, guys, quickly. Real cost, inflation, and get the nominal cost, that is inflation adjusted cost values. Okay. Just give me a minute. Meanwhile, you just try to calculate this quickly. Just give me a minute. Okay, guys. So I hope you would have got the real cost and inflation numbers. I mean, nominal cost numbers quickly. Yeah, let me just replicate it over here. So we have the nominal, sorry, real costs as 7 lakh 50, 8 lakh 50, 7 lakh 50,000, 8 lakh 50,000, 9 lakh, 9 lakh 50,000, lakh, 9 lakh 50,000, and then 10 lakh. Okay. So the inflation numbers for the cost are different. They're not same as the inflation for uh, the revenue. So we have 6%, 5%, 5%, 4%, 4%. 6%, 5%, 5%, 4%, and 4%. Okay. So let's get the nominal cost values. Nominal cost values be 7,50,000 into 1.06. That's 7,95,000. Here it is going to be 8,50,000 to 1.05 into 06. That's 9,46,050. Then we have 9 lakh into 1.06 into 1.05 into 1.05. That's 10,51,785. 9,50,000 into 1.06, 1.05 into 1.05. And then finally we have also into 1.24. That's 11,54,626. And finally the last cash flow, 10 lakh, which is a cost, real cost value of 10 lakh. That's going to be multiplied by 1.06 into 1.05, 1.05, and 4 into 1.04. That's 12 lakh 64,000 and 12. 12 lakh 64,012. These are the uh, nominal cost values that we have. Okay, so these are the nominal cost values that we are going to have. Okay. Now, once we have got the revenue and the, I mean, nominal revenue and nominal cost, we can definitely get the nominal profit before depreciation and tax. We'll have profit before depreciation and tax. But of course, we can simply do one thing. Let us calculate the amount of depreciation also. Okay. Let's calculate the depreciation also. So the depreciation numbers, I think that's going to be annual depreciation is going to be 4 lakh, which is on a straight line basis, right? So 4 lakh is the depreciation value. We're getting the depreciation value as 4 lakh. Now, of course, we can get the profit before tax as nominal revenue of 16,20,000 minus 7,95,000 minus 4 lakh, which is 4,25,000 is a profit before tax. 19,64,520 minus 9,46,050 minus 4 lakh, which is 6,18,470. That's your profit before tax. 23,27,378 minus 10,51,785 minus 4 lakh. There this is 8,75,593, 25,72,366 minus 9,50,000. Sorry, subtracting. 25,72,366 minus 11,54,626. Then for the subtracting, depreciation of 4 lakh. That's like 10,17,740. Then the final year we have 26,75,261. 26,75,261. You reduce the nominal cost, which is 12,64,012, and further subtract 4 lakh of depreciation. That's like 10,11,249. These are your profit before tax numbers. We're going to subtract tax from this. We'll get the profit after tax, right? And then we simply add back the depreciation to get the CFAT number. Okay. So we just subtract the tax, then take the PAT, and then take the depreciation. This is one way you can definitely get the cash flow after tax. But if you look at over here, the question is, independent one by one. Okay, so annual depreciation tax shield is also going to be computed. So we can actually do one thing. Instead of following this entire process of PBT, less tax, then PAT, and then depreciation, getting the CFAT, I can actually do it in a much easier way by simply calculating. I was just giving you that another approach. What we do is, let us compute profit before, or in fact, we will say, instead of these numbers, calculating all of them and then doing it, what I can get is nominal profit, right? Nominal profit before depreciation and tax. Okay. And then I simply subtract the tax value from this, right? So you get profit after tax, but before depreciation, right? You subtract the tax from this, and then you just add the tax savings from depreciation. That will anyways give you the cash flow after tax, right? So we can simply get the nominal profit, then subtract the tax from that by taking the multiplication by the 30% with it, and then take the after tax savings into it. Nominal profit, let us simply say, it's just going to be the difference between your nominal revenue and nominal cost. 16,20,000 minus 7,95,000. Nominal profit is what? 8,25,000. 19,64,520. From that, you subtract 9,46,050. Here it is 10 lakh 18,470. Then you have 23,27,378 minus 10,51,785. 785. This is 12 lakh 75,593. Then you have 25 lakh 72 366. That's a nominal revenue. From that, you subtract 11 lakh 54 626, which is the nominal cost. That's 14 lakh 17,740. Finally, we have 26 lakh 75 261 minus 12 lakh 64,012. This is 14 lakh 11,249. That's after adjusting for the inflation. You have the nominal profits available, right? And then we just subtract tax out of it. So 8,25,000 into 30%, which is 2,47,500. 10,18,470 into 30% is 3,05,541. 12,75,593 into 30% is 3,82,678. 14,17,740. On that, you take 30%. Is 4,25,322. 15,11,249 into 30%, which is 4,23,374. Okay, so these are the taxation figures that we are going to subtract. And one figure we just need to add back is the tax savings on depreciation. So depreciation is anyways given as every year. The depreciation figure is 4 lakh. So 4 lakh into 30%, that's going to be simply 1,20,000. So tax saving that we need to add back in each of the years is just 1,20,000. Okay, so we get the tax savings from depreciation added back, which is 1,20,000. Now we can get the cash flow after tax. This is 8,25,000 minus 2,47,500 plus 1,20,000. It is 6,97,500. 10,18,470 minus 3,05,541 plus 1,20,000. 7,24,929. Then you have 12,75,593 minus 3,82,678 plus 1,20,000 is 10,12,915. 14,17,740 minus 4,25,322, and you add back 1,20,000. That's 11,12,418. Then you have 14,11,249 minus 4,23,374 plus 1,20,000, which is 19,54,000. Yeah, this is 11,07,874. That's your EFAT number. Okay, let's try to answer each one of them one by one. See? Annual depreciation tax shield. That's 1,20,000. inflation adjusted revenue in year 2. Inflation adjusted revenue in year 2 is 19,64,520. 19,64,520. Inflation adjusted operating cost in year 3. So inflation adjusted operating cost in year 3, that's 10,51,785. 10,51,785. Total after tax cash inflow in year 1. So in year 1, total after tax cash inflow is in year 1, that's going to be this 6,97,500. 6,97,500. Then using a discount rate of 12%, the present value of year 4 cash flow. So we can definitely get these cash flows and their PV. So let us say they're having year, or I should write it separately. You can simply multiply it by the present value factor. So present value factors at 12%, it's 1 divided by 1.12 is 0.8929. Further divided by 1.12 is 0.7972. Further divided by 1.12 is 0.7118. Further divided by 1.12 is 0.6355. Then you're going to further divide this by 1.12, 0.5674. Let us calculate the PVs, and then of course that will go down to ultimately the NPV number. So PV is what? 6,97,500 into 0.8929. This 6,22,798. 7,24,929 into 0.7972, which is 5,77,914. 10,12,915.7118, which is 7,20,993. 11,12,418 into 0.6355, 7,06,942. 11,07,875 into 0.5674. 6,28,608. That's your PV. So we'll take the NPV number as, just add them all. Right? So if you're going to just add all the PVs, you're going to get 6,22,798 plus 5,77,914 plus 7,20,993 plus 7,06,942 plus 6,28,608. That totals to 32,57,255 minus the cost that we have. The cost that we have $32,57,000 minus what's the cost of the project? Well, the cost of the project is 20 lakhs minus 20 lakhs. We get the NPV number as positive 12,57,255. Of course, this project seems to be financially feasible. So this project is definitely financially feasible, and we can go ahead with this project list. Okay, we can go ahead with this project, 12,57,255 being the NPV. You can simply calculate that the positive, since the NPV is positive, the project can be given a go ahead. Okay, so that completes our question number 2. Okay, so one thing that I need to highlight over here is that the depreciation is never going to be adjusted for inflation. Okay. Depreciation is never going to be adjusted for inflation. And in fact, what we can say is the number of uh, tax saving on depreciation, that's also going to be a constant term. Tax savings from depreciation is also going to be a constant term for all the future values or for all the future years. Okay, because there's no inflation adjustment to the depreciation. Apart from that, all the revenue, all the cost items can be adjusted for inflation. In this case, we had the inflation number different for the revenue and the inflation number being different for the cost also. So for revenue and for cost, there were two separate set of inflation. But when it comes to tax savings and depreciation, no impact of inflation is going to be considered in it. Okay, fine, guys. Okay, so that completes our second question. Now, of course, the third question is definitely an interesting case for us to discuss. So it's going to be very interesting case, and we'll be discussing this case after we come back from the break. Let's take around 10 minutes of break, and then we come back and continue with this question number 3, which is regarding the adjusted present value. Okay, let's take a break, guys, and come back in around 10 minutes. Okay, let's meet after the break, guys. Alpha Green Energy Limited. So Alpha Green Energy Limited, equity, subsidized government debt, and market borrowings. The board has decided that the project should be evaluated using adjusted present value approach because the financing package contains several financing side effects. So we are going to evaluate it using adjusted present value approach. Okay. So in this adjusted present value approach, we know we first calculate the base case NPV, right? And then the base case NPV is adjusted for the amount of debt. Okay. The finance director has gathered the following information. So as a finance director, we are having certain information, which is cost of land and building, cost of plant and machinery, right? And then initial working capital requirement. Okay. The working capital will be fully recovered at the end of year 5. Project is having an economic life of 5 years. The land is expected to be sold at 150 crores at the end of year 5, right? Then land is expected to be sold at 150 crore at the end of year 5. Plant and machinery are expected to have a salvage value of 24 crores at the end of year 5. Okay. Uh, Depreciation under the Income Tax Act is allowable on plant and machinery using written down value method at 25%. Ignore depreciation on land and building. We are saying there's no depreciation on land and building. Operating forecasts, the expected operating results before depreciation and interest. So you have the revenue and operating costs given to you. Revenue and operating costs is excluding depreciation. Additional information is annual maintenance expenditure of 6 crore is included in operating costs. Inflation has already been incorporated in all cash flow estimates. Corporate tax rate is 30%. Taxes are paid in the same year. Financing plan, the project will be financed as follows. First up, government soft loan, 100 crores. So look at what's the cost of our project. Total capital that we need to put is land and building, plant and machine, and this total 120 plus 240, which is 360 plus 30 at 390. Okay. So 390 is the amount of investment that on which interest rate is 5%. And if you borrow from the market for similar risk, then you have it as a 10%. Principal is repayable in one lump sum at the end of year 5. So there's no EMI concept over here. The entire principal is going to be repaid in one lump sum, one single amount in the year 5. Term loan from bank is 120 crores. Interest rate is 10% per annum. So if you're going to borrow, let's say 120 crores out of 100 crores, if you're going to borrow out of total requirement, you're going to borrow another 120 at 10%, and interest is payable annually on the outstanding balance. Now here the principal repayable is happening equally over from year 2 to year 5. Principal is going to be repaid, and of course, as the principal is repaid, the interest is also going to be adjusted. Equity, remaining investment will be financed through equity. Financing side effects. Issue cost saving. If the company financed the project entirely with equity, flotation cost would have been 4% of equity raised. Because of debt financing, equity issue is reduced accordingly. Okay. So if it is issued entirely by equity, the flotation cost would be 4% of the equity raise. Because of debt financing, equity issue is reduced accordingly. Assume flotation cost savings occur immediately. Government is going to provide a capital subsidy 20 crore immediately after commencement of commercial production, which is from end of year one onwards. The subsidy is not taxable. Financial distress cost. The management estimates that due to increased leverage, there is 10% probability that the company may incur financial distress cost amounting to 30 crore at the end of year 5. Asset, the sale proceeds of land and machinery at the end of year 5 will be taxable based on applicable tax provisions. Okay, we'll see if there are any tax provisions. Cost of capital, unlevered cost of equity is 14%. Market value debt ratio of comparable unlevered firm, we don't have any. Discount operating cash flows using, of course, 14%. So first we need to get the base case NPV, assuming the project is entirely equity funded. Okay. So you have the market value of debt and discount together. Then we have the base case NPV if it is entirely equity funded. Second is compute the present value of tax shield which is arising from government soft loan and also from commercial term loan. Compute the present value of interest subsidy arising from concessional government loan. Compute the present value of flotation cost savings. Compute the expected present value of financial distress costs. Determine the adjusted present value of the project. Comment whether the project should be accepted. So we have to do a lot of calculations in this question. We already have enough data for like it's like a real, almost like a real practical question, a practical problem that we face in the real life scenario. So starting with the base case NPV, assume the project is entirely equity financed. So first up, let's talk of what is the amount of investment that we need to have. What's the amount of investment that we need to put in? Okay. So calculate the amount of investment that we need to make. First, let's compute the initial investment. So as far as initial investment is concerned, we need money for land. We need money for land. Uh, then we need money for land and building, plant and machinery, and initial working capital. Okay. So here we say cost of land and building, we have 120, 240. We have land and building, 120. We have plant and machinery, 240. Plant and machinery, 240. Initial working capital of 30. initial working capital of 30. So total funds that we need, initial outflow. So initial outflow is going to be 390. Okay. So initial outflow is going to be 240. Sorry, 390. Now, of course, we need to calculate the depreciation also, because the question says that depreciation has to be at a written down value method at 25%. Written down value method, written down value method at 25%, right? So let us prepare the depreciation schedule. Okay. So let's prepare the depreciation schedule, because anyways, the question says we have to ignore depreciation on land and building. So since that depreciation has to be ignored, we just need to depreciate the plant and machinery at 25%. So let us say computation of depreciation. So computation of depreciation at 25%, I'm going to depreciate it for 5 years. So computation of depreciation, because we are going to take this depreciation numbers. We have year one. What's the life of the project, by the way? 5 years. Okay. Life of the project is going to be 5 years. So year 1, 2, 3, 4, 5. For all these 5 years, we have the depreciation as opening WDV. Then we rate the depreciation. Then we have the closing value. So opening, it is going to be obviously plant and machinery. Opening depreciation is, opening WDV is 240. On that, we are going to charge depreciation at 25%. So 60 being the depreciation. Closing is 180. Opening is 180. On that, 25% is 45, which makes it as 135. So we have this opening as 135. On 135, the depreciation of 25%, which is 33.75. So 135 minus 33.75, which is 101.25. So closing value is 101.25. 101.25 into 25%, is 25.31. 101.25 minus 25.31 is 75.94. This being the opening value. We get the depreciation 75.94 into 25%. That's 18.99. And we have the closing WDV on the plant and machinery as 56.95. Okay. Okay. So we are done with the depreciation calculation. Now, the next thing that we are going to check is what is the operating cash flow that we are going to have. Okay, operating cash flow or cash flow after tax. For that, we have the revenue and the operating cost. Okay, so Let's go for calculation of cash flow after tax. Now, of course, here we are assuming there is no interest or anything, right? Because we are saying it's a base case NPV that we have to get first. We have the revenue and operating costs. So calculation of CFAT, we'll have it as computed throughout. We have year 1, 2, 3, 4, 5. First, we start with revenue, S operating cost. Okay, revenue less operating cost. Then annual maintenance expenditure is definitely included in the operating cost. Inflation has already been incorporated. Tax rate is 30%. Tax is going to be paid in the same year. Okay. So revenue less operating cost we have. We are going to further subtract depreciation. So we get profit before tax. From that we subtract tax. We get profit after tax. And then we add back depreciation or CFAT. Okay. So we have to complete this particular table, guys. So we will be getting the cash flow after tax based on this, which is this is under an assumption that it is fully funded by equity, guys. Okay, so it's under an assumption that this project is going to be fully funded by equity. Therefore, we haven't considered any interest impact in this. Okay, because that's the way we compute the base case NPV or base case present value, by assuming there is no debt funding. We already have the revenue and operating numbers, operating cost numbers, tax, and then the CFAT. So just take around a couple of minutes and try to get the CFAT for each of these 5 years, everyone. You already have the depreciation calculated. Try to calculate the CFAT. Take a couple of minutes. Okay, let's start. So revenue we have 220, 255. Revenue 220, 255. Then we have 90, 315. 90, 315. 330. Operating costs. Yeah. So operating costs are 125, 138, 155, 170, and 178. We get the depreciation numbers also. which we have completed, which is 60, 45, 33.75, 25.31, 18.99. Then we get the profit before tax numbers. Okay, so this 220, 20 minus 125 minus 60, 25 minus 125, 50 minus 125 minus 60. So that's PBT is what, 35? PBT is 35. We have PBT as 255 minus 138 minus 45 is 72. 290 minus 155 minus 33.75, which is 101.25. 315 minus 170 minus 25.31 is 119.69. We have 330 minus 178 minus 18.99 is 133.01. So these are the PBT numbers, or profit before tax numbers. Five minus 138 minus 45, 75 minus 138 minus 45. Then you have 290 minus 155 minus 33.75, 315 minus 170, minus 25.31, 330 minus 178 minus 18.99 minus, so EBT. Now we're going to subtract tax at 30%. So 35 into 30%, that's 10.5. Then you have 72 into 30%, that's 21.6. 101.25 into 30%, that's 30.38. Then you have 119.69 into 30%, which is 35.91. Then 133.01, which is a PBT. On that you have 30%, which is 39.90. So we get the PAT figures as 35 into 24.5, 72 minus 21.6, which is 50.4. Then we have 101.25, 101.25 minus 30.38, 70.87, 119.69 minus 35.91 is 83.78, 133.01 minus 39.9, which is 93.11. So that's your PAT. And then we add back the depreciation, which is 60, 45, 33.75, 25.31, and 18.99. Let's add them. 24.5 plus 60 is 84.5. Then this is 95.4. Then this is 70.87. Add back 33.75. That's 104.62. 83.78. Add back 25.31. 109.09. 93.11 plus 18.99 is 112.1. Okay. These are our cash flow after tax numbers, guys. That's the first thing that we have done. Cash flow after tax numbers are ready. Okay. So once we get the cash flow after tax, then we definitely will move for the calculation of base case NPV. So we have like 5 years. We also need to check what are the terminal cash flows that we are going to have that we will be taking up when we are calculating the base case NPV. So let us say the base case NPV is the unlevered. Okay. So we are going to have in this year particulars. Okay. Then we will have the cash flows, present value factor at certain rate, and then PV. The first is identify the cash flows. Of course, in year 0, there's going to be initial investment. Okay, then in year 1, 2, 3, 4, 5, for all these 5 years, we are going to have the cash flow after tax, right? Net cash flow after tax. So discounting is going to be done at 14%. Cash flow after tax is calculated. And then in the 5th year, we do have certain cash flows, which are the terminal cash flow sort of thing. First up, you can see plant and machine expected to have a salvage of 24 crores at the end of year 5. In year 5, we will say salvage of plant. Okay. Then again in year 5, they're saying land, but we will say sale of land and building both. Can't sell land and building separately, right? Sale of land and building. Okay. Sale of land and building. Then, of course, in the 5th year, working capital will be recovered. Okay. With regards to taxation, there was an important point. The sale proceeds of land and building at the end of FI will be taxable based on applicable tax provision. They're saying land and building, they'll be taxable on applicable tax provision. They're not saying anything about the sale of plant and machinery because that is anyways a depreciable asset. But we have that applicable tax provision. It means we are going to say that it's the same tax rate which will be applicable because in the absence of any tax rate given to us separately, we can definitely say that the tax on land and building will be same as tax on land and building will be same as the regular tax. We can obviously assume that that's an assumption over here. It will be tax on land and building. Now, what is the sale value of the land? The sale value of the land is anything specified about the land is expected to be sold at 150 crores at the end of year 5. Right? So tax will be 150 being the sale value. And what is the cost we have purchased? We have purchased it for 120. So on that, you have 30% tax. Okay. So we have to calculate these cash flows and then take the present value. So just try to calculate the cash flows and take the present value, guys. Try to calculate the cash flows and get the present value. I'll just give you a couple of minutes for this. So I think you'll be able to identify the cash flows easily. Cash flows can be done quite easily. The initial investment cash flow, since the base case, it is going to be 390, which will be obviously an outflow. Okay, so then we have the CFAT numbers. CFAT numbers are what? 84.5, 95.4, 104.62, 109.09, 112.1. Salvage value of the plant, that is 24. Okay. Salvage value of the land and building is 150. Working capital recovery. Working capital that is invested will be recovered. So working capital was what? 30 crores. Then tax that we are going to pay on sale of land and building is 150 minus 120. On that we have 30% tax. 150 minus 120, which is 30. So on 30 you pay 30% tax, which is 9. So that's a outflow which we have, right? So let's just check if we are missing out on any other cash flow. Project economic life, land is taken care, plant is considered, depreciation is considered, land and building, there's no depreciation, revenue cost and everything is done. Then this loan category is anyways going to be considered under the other aspects. Then entirely flotation cost will be 4% of equity raised because of debt financing. Equity issue is reduced accordingly. So government subsidy, commencement of, yeah, we need to consider one more thing over here, which is the government subsidy. So government subsidy is going to be provided to you, 20 crore immediately after commencement of the commercial, which is at the end of year 1. Okay. Okay. So government subsidy of 20 crores will be paid, 20 crore immediately after 1 year. So I need to have one more cash flow, which is happening in, let's say, in the year 1. So in year 1, we are having a government subsidy also. And remember, this is a non-taxable subsidy. So government subsidy of capital subsidy of 20 crores. That's an inflow for us. Okay. Then this financial distress is of course considered when we are computing uh, that will be coming. I mean, the financial distress cost is going to come obviously after the case if you're taking a debt. Okay. So I think we have considered each and everything over here. So now we are in a position to calculate the base case NPV. And remember, it's not a case over here that government is going to provide you by only, I mean, subsidy only if you take a loan. So this is obviously, it's a separate item altogether. So present value factors, let's say this is one. For the next thing, it is going to be 1 divided by 1.14, which is 0.8772. So divided by 1.14, 0.7695 divided by 1.14, 0.6749 or 0.6750, further divided by 1.14, that's 0.591 for fifth year, divided by 1.14, that's 0.5194. Okay, so this same 0.5194 will be applicable over multiple cash flows, working capital recovery, tax that we are going to pay on land and building. Government subsidy is anyways coming in first year, so PV factor of 0.8772. Okay, let's take the PV values. So this 390 negative, then we have 84.5 into 0.8772, 74.12, 95.4 into 0.7695. So that's 73.41, 104.62 into 0.6750, which is 70.62, and 109.09, 9.09, 0.5921, which is 64.59, 112.1, 0.5194, that's 58.22. 24 into 0.5194, 12.47, and 50 into 0.5194. 77.91, 30 into 0.5194 is 15.58. 9 into 0.5194 is 4.67. It will be a negative because it's a cash outflow. 0.8772 into 20 is 17.544. right? So that's your present value, or you just need to add all of them to arrive at the NPV or the base case NPV. So it is 74.12 minus 390 plus 73.41 plus 70.62 plus 64.59 plus 58.22 plus 12.47 plus 77.91 plus 15.58 minus 4.67. So the total thing, I mean, adding up all the things and then add 74.12, 390, 73.41, 70.62 added, 64.59 added, 58.22, 12.47. Then you have the sale value of land and building is 77.91, 15 point minus, and then we need to add back 17.54. So this comes out to be 69.79. So this is the base case. The base case, present value of base case NPV is 69.79. So that gives us the answer for the first one, which is base case NPV, assuming the project is entirely equity financed. Okay. Then compute the present value of tax shields arising from government soft loan and commercial term loan. So in both cases, I need to get the present value of tax savings. So tax savings will be obviously on the interest only. Right? So then we have to compute the present value of interest subsidy arising from concessional government loan. So interest subsidy, and then present value of the flotation cost saving and expected present value of financial distress cost, and then we go for the adjusted present value. So let's go for one by one. First up, compute the present value of government soft loan, tax shield on government soft loan, and commercial term loan. Now, let us go for first the government soft loan. Second part, B part of the question, we are calculating present value of tax shield, present value of tax shield arising from government. So what was the term of government loan? What was the term of government loan? So government loan was saying government soft loan is for 100 crores. Amount is 5%, market borrowing rate is 0. But here they're saying principal is repayable in one lump sum at the end of year 5. So principal will be repaid at the end of year 5. But every year we are going to pay a tax. We are going to pay interest of 5%. So we need to first get interest per annum. Interest per annum is 100 crores into 5%, which is 5 crores. Okay. We'll simply say, therefore, present value of tax savings, present value of tax savings from interest from the government loan. Right? So present value of tax savings from government loan, that will be of course 5 crores multiplied by present value annuity factor. So of course now I need to check is present value annuity factor for 5 years definitely, but what should be the rate I should take? Should I take the rate as 14%, or should I take the rate as 5%, or should I take the rate as 10%? best way to look at is, present value of tax saving, because since you're paying interest on that interest, you will be saving tax, and that tax is getting saved because of the government loan. So we are going to take the present value using the same 5% thing. Okay, so let's discount these present value. So because this present value of tax saving is going to be, this tax savings is ultimately going to happen to the company. And let's do one thing. Since the tax savings is going to happen to the company, we can definitely say that this is going to accrue to our equity shareholders, right? So there can be different perspective to that. Whether should we discount it at interest rate charged by the government? Should I take it as an interest rate charged by the uh, no, it is going to be charged by what the market rate, or should I take it as the discount rate which the equity shareholders want? Of course, this tax savings is not something which is, arising as, benefit from investing in any project. So ideally, when you look at any references, we discount it using the applicable rate of interest. So we simply say uh, present value of tax savings is going to be this 5 crores into tax rate of 30%. So we're going to say 1.5 crore every year. You just need to multiply it by present value annuity factor at 5% for 5 years. So that's like 1.5 crores into present value annuity factor at 5% for 5 years. So we need to get the annuity factor. So one second. So annuity factor is going to be, second. Let me calculate the annuity factor here using Excel. 1 divided by 1.1 and 5 raised to, it is 4.3295. 4.3295. So annuity factor is 4.3295. You can multiply this 1.5 into 3295. Yeah, that's 6 point. This is 6.49. 6.49 crores. That's the present value of tax savings from government loan. Same way, we are going to get present value of tax shield arising from present value of tax shield arising from market loan. So the loan that we are taking from the market, that's 120 crores and interest rate is 10%. So from market, so we need to calculate it differently, guys, because there is a principal repayment happening. So principal is repaid equally over year 2 to 5. We have to prepare that schedule of amortization. See here, opening balance, then you have interest, then you think of course, repayment, then you have the closing balance. So year 1, 2, 3, 4, 5. opening balance of loan that we're taking from the market or from the bank rather, from the market, it is from the bank. So when we're taking the loan from the bank, the loan amount is 120, interest rate is 10%. The loan amount opening balance is 120. 10%, so first year interest is of course 12, and repayment is nothing. So closing balance is 120. And then we'll simply say what is the amount of interest into tax, because that will be the tax saving. Then we write down the present value factor and then take the present value of it. Okay, this is the tax saving that we have. So opening is 120, interest is again 12. But since the interest, I mean the principal repayment is happening from year 2 onwards. From year 2 onwards. So second year, you're making a repayment of, repayment is happening equally. So equally over a period of 4 years, second, third, fourth, and fifth. By the end of second year, you are repaying 1/4 of it, right? Which is 30. Closing is 90. So you have 90. On that 90, you're paying interest of 9. Again, repayment of 30, your closing is 60. So opening 30, interest is going to be, opening is 60, interest will be 6, repayment again 30. We are left with 30. Closing 30, interest again 3. And then you have the repayment of 30, and this closing balance is 0. So now we have the tax savings as interest multiplied by tax rate, which is 12 multiplied by 30%. This is 3.6. Then again, 3.6 is the tax saving. 9 into 30%, which is 0.7. 6 into 30%, which is 1.8. Then 3 into 30%, 0.9. That's your tax saving. 3.6, 3.6, 2.7, 1.8, 0.9. 9, of course, we're going to take the PV factor at 10%, which is the cost of that particular loan itself. Okay, so we are going to simply discount it using the same rate which we are charging, which the bank is charging to us. So that's going to be 1 divided by 1.1. That's 0.909. Further divided by 1.1. 0.8264. Further divided by 1.1. That's 0.7513. Further divided by 1.1, which is 0.6830. Further divided by 1.1, which is 0.6209. Let's just take the present value now. 3.6 into 0.9091. That's 3.27. 3.6 into 0.8264. 2.98. 2.7 into 0.7513. 2.03. 30 into 1.8 into 0.6830 is 1.23. 0.9 into 0.6209. 0.56. Let's add them all together. 3.27 plus 2.98 plus 2.03 plus 1.23 plus 0.56. So that's 10.07. So present value of all tax shield arising from the bank, it is 10.07. Okay. So that is done. Then we have the present value of this thing. Then present value of interest subsidy arising from concessional government loan. The present value of interest subsidy that we have over here is C part. Present value of interest subsidy. That is pretty simple. Present value of interest subsidy from government. We say that we are paying interest under the government scheme as 5%. But if you would have borrowed it from bank, it would have charged us 10%. So essentially, 5% of 100 crores is something that we are saving. And I just need to multiply it with the present value annuity factor, because every year you're saving 5%. So now it's going to be 5% for 5 years. So it is simply 5 crores into 4.3295. 5 into 4.3295 is 21.65 crores. That's the present value of interest subsidy which is arising from the concessional government loan. From the concessional government loan, you are saving 5 crores every year. So that's the value we have. Then the present value of flotation cost saving. Now, what will be the flotation cost savings that we are going to have? So if the company financed the project entirely by equity, flotation cost would have been 4% of equity raised. Because of debt financing, equity issues reduced. Now, let us say is the issue cost over here. Now, this is like 30 crores financing plan. Now, issue cost is something that's not no specially provided. So we can definitely say that if the company's finance project entirely by equity, flotation cost would have been 5% of equity raised. So, we can definitely say this is like the change. Flotation cost saved would have been 4% of equity raised. Whatever would have been the issue cost, against that you will be saving 4%. So that will be just savings in issue cost. Savings in issue cost due to equity, due to equity funding. That will be 4% of equity raised. It will be 4% of equity raised. So equity amount that will be bought in by this entity will be like 100 crores, and 120 crores out of 390 is funded by debt, right? So that will be 390 minus 100 minus 120. So this is like 4% is the issue cost that we are having. If we are getting it by way of 4% is the cost, issue cost that we are having for the equity that we have raised. Now, if you would have raised it fully by equity, the flotation cost would have been, saved. So that will be 390 minus 100 minus 120. 390 minus 100 minus 120, which is 170. On that, you have 4% saved, which is 6.8. So that is anyways, going to be the cost that is saved instantly. It's not something, deferred. So that is done. Present value of flotation cost. Now, expected present value of financial distress. Now, with regards to financial distress, they're saying financial distress cost would have been 30 crores at the end of 5 years. So due to increased leverage, there is a 10% probability the company may incur financial distress cost amounting to 30 crore at the end of year 5. We'll say E, present value of financial distress cost. Present value of financial distress cost, which is 30 crores, but this 30 crores is likely to be there with a 10% chance. It's a 10% chance, so 10% into present value factor. Now, this financial distress obviously is going to be from the debt. So I will take the cost of, the discounting rate at 10% for 5 years. So 30 into 10%, right? Alternatively, you can take the average of the government rate and the average of the bank rate. You divide this 1 divided by 1.1 for fifth year. Fifth year, anyways, we have the PV factor. So 30 into 10% chance, and this is going to be 0.6209. So 30 into I have 10% into 0.6209. This is 1.8627. Finally, determine the adjusted present value of the project. So adjusted present value of the project will be uh, the present value or NPV if we take the funding to be by way of debt. Okay. So finally, we have F as the adjusted present value, which is going to be base case present value. Adjusted present value is simply going to be the base case present value. To that, we are going to add tax savings from interest. Okay. This is simply present value of tax savings from interest. Okay. And also, the thing that we are going to save is savings in the issue cost that's going to happen. So since we have the equity funding, that would have been cost us, saved us 6.8 crores. But since we are going for debt funding, I need to incur this additional cost plus present value of savings in, whether it should not be plus, it should be subtracted, minus present value of savings in full equity funding. Okay. And then further, we'll also subtract, because you're going to take a loan, you're going to face also the financial distress. It is minus present value of financial distress. Present value of financial distress cost. Okay. So we have the base case present value already calculated, which is 69.79. To that, we will add the present value of tax savings from interest from both the parties, which is 6.49 from government and 10.09 from the bank. So we add to it 6.49 plus 10.07. Present value of interest subsidy from government. Then, savings in interest issue cost. This is the amount that we are going to save if we go for equity funding. And also present value of financial distress cost needs to be subtracted, 1.8627. This is the benefit that you take. The savings in tax that you have, that's the benefit that you have when you take a loan. These two are the costs that you have when you're going to take a loan. So over and above equity, these are the savings and costs that we are going to incur, and we are going to account for both of them. And finally, the adjusted present value will be 69.79 plus 6.49 plus 10.07 minus 6.8 minus 1.8627. This is 77.6873. This is the final adjusted present value for this particular question raise. Now, of course, the last question says, compute whether the project should be accepted. Definitely, yes, the project seems to be acceptable because even the adjusted present value is positive and base case present value was anyways a positive figure. So even if you go for debt funding, still you will have a good amount of number, net present value number, which will help you in understanding that the project should be accepted. Okay. So this is what a full-fledged, question you may face in your real life situation. These are very nitty-gritty, something here and there that you're going to have when you're actually sitting down on the table and trying to figure out what will be the present value and the adjusted present value stuff. Okay. So that's how the present value or adjusted present value is going to be calculated. And not only this case, you're going to face this sort of situation in almost every capital budgeting scenarios. We have definitely calculated using pen, paper, and going ahead when you enter the work profile, you will be doing it with Excel and other softwares. But the concepts still remain the same, that you need to account for present value of your tax savings. You need to consider what will be the extra cost that you will incur if you're going to take a borrowing instead of full equity. So all those permutation combination needs to be adjusted before you finally go for deciding whether the project should be accepted or not. Okay, so we have completed all the three questions. Now, before we wind up the session, I would like to highlight one more important aspect of the advanced capital budgeting, which is the uh, tree diagram. So just be very cautious about the tree diagram questions, or those questions where the probabilities are involved based on the tree diagram. So let's say you have a choice whether to start with a project or not. Okay. Of course, if you start a project, then you will have, let's say, an investment of 10 crores. Okay. Now, this 10 crores of investment, initially you may face success or you may get failure. Yes, initially you may get success or you may get failure. So let's say if you are having a success, we're talking of the year one situation. If you're having a success, then year one cash flow will be, let's say, 5 crores positive. And if it's a failure, year one cash flow is going to be, let's say, just 1 crore. Now, further, you have a choice from here whether to continue in year two or not. Okay. So again, you have answered yes or no. Here also you have answered yes or no. Now, if you continue in the year two, right, here you're having a choice whether to continue or not. If you continue in year two, you will get possibly a cash flow of, let's say, 8 crores. And if you don't continue, of course, no cash flow in year two. Same way, in the second category, if the project fails and if you continue in the second year, you may get cash flow of, let's say, 4 crores. Okay. And if you're not continuing, of course, then it is going to be 0. Now, after you go ahead, right, with this situation, that whether you continue or not, when you say you are going to continue, you can obviously see that there may be two different situations from here. So from here, you may again face success or failure. If it is successful, let's say you get a cash flow of 8 crores. If it's a failure, then you have a cash flow of 1 crore. Same way from the second way, if you face the failure, not a complete failure, but not as per the targets. If you get a same amount, failure in the first year, and if you choose to continue, then again you will have like a success or a failure situation. So for a success failure, so if it succeeds in the second year, then you're likely to get, let's say, 6 crore. And if it fails, then of course you're not, you're going to get just again 1. Now, one thing I would like to highlight, you can definitely take the present value and all such things calculating it. But one important point that you need to look at is, suppose I tell you that probability of success over here is 0.7 and probability of failure over here is 0.3. And that same probability, let's say probability of success in second year, if it is 0.8, and this is going to be like having a probability of 0.2. Same way here, we are going to have a probability of, let's say, 0.5, and this will have a probability of 0.5. Now remember these probability numbers, 0.8, this probability number is dependent on you getting success in the first year. Okay. So if I ask you what is the probability of you reaching this 8 crores, what's the probability of you getting this cash flow of 8 crores, don't take it as 0.8, because that 0.8 is dependent on this. So here, this term is going to have a probability of 0.8 into 0.7. Because remember, you get this 8 crores only if you have succeeded in the year one and you choose to continue. So succeeding and again another success in the second year. success in first year and second success in the second year, then you're going to get this 8 crores. So this 8 crores is going to have a probability of 0.8 into 0.7, which is 0.56. Okay. This 0.5 crore is definitely going to have a probability of 0.7. Okay. So just keep a note of it that the node probabilities needs to be computed by using this particular formula, guys. It's going to be like a combined probability. You can't take the probability of 0.8 in isolation. Okay, just keep a note of it because most often students make this mistake. So I just thought of, highlighting it to you before we, wind up the session. I think we have completed the revision of the advanced capital budgeting. If any one of you have any queries, you can just highlight it.
Thank you, Jagbandhu sir.
Thank you, sir.
Okay, now your session was very knowledgeable because you have very lucidly explained the brief, all the related concept in a very lucid manner, as well as the choice or the selection of the questions is also very dynamic because you have covered the question of like a topic of adjusted present value, which is the need of the hour. Because nowadays approximate all the projects are, we can say, financed by the mix of like concessional loans, etc. are there, and as well as if we see the trend of this paper May 2026, this type of questions are normally asked, have been started asking in the examination. And you are also, so this topic is very important, and as you have said, quite very rightly said, that it is the advanced version of the capital budgeting decisions which are practically used. Okay, because now the trade, of course, a part of the same has also been covered in our FM paper. Okay, so now it is advanced version, and here we have to take advanced decision as well. So student, thank you very much for your patient listening. Now Jagbandhu sir have explained everything in very good manner. Now still, if you have any query, so we welcome you all to contact us. Jagbandhu sir, just write down our contact number as well as our email ID. Yes. So student, this is our contact email ID, that is sfm-final@ici.in. And this is our contact number 0120. It is STD code 3045956. So student, thank you once again, and please revise the question that has been discussed in the class. And if you have any query, please do contact us. Thank you very much and have a nice day. Thank you, Jagbandhu sir, and have a nice day. Thank you. Yes, session over. So, Shubhjit, session. Thank you. Thank you. Have a nice day.